Hi everyone, my name is Ina Volovic and welcome back to my channel. I am the IRS enrolled agent who helps traders and investors keep more of their hard-earned money instead of overpaying the IRS. Not long ago, I worked with a day trader who cut their tax bill by over $30,000. They did it legally using strategies that are completely allowed by the IRS rules. Today, I'll walk you through exactly how that works. I'll share the top tax hacks for day traders, the same ones I used for my client. Here are the reality. Millions of traders and investors pay too much in tax every year. The reason is simple. They don't know how the IRS classifies them. And that classification decides which tax rules applies. These are three categories the IRS recognizes: investors, traders, and businesses. Each one has different rule, different benefits, and different risks. Choosing the right one or setting yourself up to quality can mean a difference between overpaying thousands and keeping that money in your pocket. So let's break this down. The first one category is by the default investor. This is where you land if you do nothing. And unfortunately, it is also the least favorable for the day trader. And here's why. Short-term capital gains are taxed as ordinary income rates, which can be as high as 37% federally. To get long-term capital gain rates, you'd have to hold your positions for more than a year. Most day traders don't. Expenses are another problem. As an investor, you can't deduct trading software, your home office, education, or even paying for help. Losses aren't much better. Capital losses only offset $3,000 of your other income per year. The rest is just carries forward. So if the IRS sees you as an investor, you're stuck with high taxes and very few benefits. Now let's look at the second category, trader. This is where things start to get interesting. With day trader classification, you can deduct your expenses as you're running a business. That means deduction for your home office, your trading technology, education and training, and even paying contractors or family members who legitimately help you. Here's an example. So you make $100,000 in short-term trading gains, and you have $30,000 in legitimate expenses. As an investor, you'll be taxed on the full $100,000. As a trader, you can deduct those expenses and are only taxed on $70,000 in a high bracket that's more than $11,000 saved. So how do you qualify? The IRS doesn't spell it out in the tax code, but court cases and guidelines give us the rules. You profit from daily market movements, not dividends or long-term growth. You typically hold positions 31 days or less. Your activity is substantial, usually hundreds of trades per year, and you trade with regularity, often at least 75% of the available trading dates. If you meet these, you can unlock trader status and the benefits that come within. If you don't worry, there are still advanced strategies available. Now, let's move into a third classification, and that's business. This is the most powerful option for serious traders, and here's how it works. Normally, even as a trader, your capital gains and losses go on Schedule D, while your expenses go on Schedule C. That limits how much you can use losses to offset other income, but with Section 475 mark-to-market election, you can treat your trading as business income or losses. This changes everything. If you lose $100,000 in a year, you aren't stuck with $3,000 limit. You can offset your entire W-2 or other income. In the 37% bracket, that's $37,000 tax saving in a down year. This election isn't for everyone. It has pros and cons. You'll definitely want to consult a tax expert before filing, but it's one of the most powerful tools available to traders. Now let's talk business structures and advanced strategies. What if you don't fully qualify for trader status? Or what if you want even more flexibility? This is where entities like partnerships or LLCs come in. For example, partnerships can send guaranteed payments to partners, which are treated as business income. By combining a trading entity with a management company you own, you can turn trading income into business income. That opens up a much wider set of deductions. You can hire a family member, deduct home office and technology cost, use Augusta rule, and set up retirement plans. But here's the warning. These setups are complex. One wrong step, like misclassifying guaranteed payments or moving a personal account into a business account, can cause a serious tax problems. That's why working with a tax expert is not negotiable for advanced strategies. So let's recap. Investors pay the most and get the least benefits. Traders get business deductions but still report gains and losses on Schedule D. Businesses with the right elections and structures unlock the most powerful strategies. If you're serious about day trading, understanding these classifications can save you tens of thousands of dollars. I help business owners and traders create smart tax strategies every single day. If you found this video helpful, hit like, subscribe, and share this video with someone who trades actively, and drop a comment below with your question. I may cover your situation in a future video. Thanks for watching, and I'll see you in the next video.